RMDs, what are they as they relate to IRAs? Social Security, when is the best time to take it? Income riders as they have to do with insurance products, what are they all about? Tax planning, what is that? Risk analysis, do you know how much risk you're taking in your portfolio and maybe want to find out? Well folks, stay tuned because we're going to be talking about all those things today.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome. Listen, in this segment, I want to talk to you about RMDs. Now, what are they? RMDs are just simply required minimum distributions that you have to take from an IRA once you reach a certain age. Now, understand this, IRA money is money that's never been taxed. So somewhere down along the line, Uncle Sam basically wants you to start taking it out because they basically want to start taxing it. So at the age of 70 and a half, the year you turn 70 and a half, they require you to take your first what's called RMD or required minimum distribution. Now a lot of people will ask, Larry, how much is that? In the first year, it's based on your life expectancy, but in the first year it's about 3.6%. And then it kind of goes up each year as you get older. If you reach the ripe old age of 105, guess what? It's 50% is what they want you to take out of that IRA in tax. So that's now in that first year that you're required to take an RMD. You can wait to the second year. But then, and you got all the way to April 15th of that next year, but then in that year you got to take a double one. So you got to be very, very careful. Now, RMDs, a lot of people don't recognize this. You know, they doubled the standard deduction, so a lot fewer people are able to itemize their deductions because for a married couple, for example, that's now $24,000. So a lot of people aren't itemizing their deductions anymore. If they're giving to charity, they're not being able to deduct that charitable contribution. But you should know that you can take your RMD, that required minimum distribution, give it directly to charity, and it never counts in your income. So in essence, you get the deduction for it and didn't even have to itemize it. So that's a good thing to know. We'll find a lot of people, it's time for them to take their RMD. They don't really need it for income. A lot of times we'll encourage them, well then just take that RMD and once you put it on some life insurance contract that's going to leave a greater legacy for your heirs. That's something that can be put into the planning. Now you have to understand, and we'll get this asked a lot, a lot of people want to take the RMD and they want to also do a Roth conversion. Meaning they want to pay the tax on their IRA and convert it over to a Roth. Now we've talked about this previously in other shows, but there's no limit to how much you can do with a Roth conversion. All right, so a lot of people get this time when they get their RMD and say, Larry, I'm going to do a Roth conversion. Will that satisfy the RMD? And unfortunately, it does not. The RMD has to be a whole separate thing from the Roth conversion. They can't satisfy each other. The other thing we want to know with RMDs is what bracket am I going to be in when I have to take those RMDs? Very important to know when we start doing our tax planning. So hopefully this is some good information for you. If you ever have any questions on RMDs, if you're getting close to that age and want to know what the rules are, then please give us a call.
We look forward to helping you plan to retire well.
Are you retired or approaching retirement in the next 5 to 10 years? Join the Centennial Wealth Advisory team for an exciting presentation with complimentary gourmet dinner and learn essential financial strategies for a comfortable retirement. 3 dates and locations to choose from. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Call 888-608-5825.
Hi, welcome back. Listen, in this segment, I want to talk to you about Social Security and how to optimize it or maximize it for your benefit. Now, believe it or not, we actually have tools that can do this for us. If we know how much your income is going to be in Social Security at full retirement age, okay, we know what your age is, and most importantly, and you're going to find this humorous, we know when you're going to die. We can actually tell you the best strategy to take for Social Security and when to take it. Okay, now this tends to be a big question we get asked a lot. You know, most people know they can take it early at 62. Okay, they know they can wait till age 70, or they can pick anything in between, right? And they know the benefit is going to be double if they wait to age 70 from 62. But what is their circumstances, Warren? Are they better to take it early or wait? Well, again, based on these tools, we can dig in and we can actually show them the best strategy. But I want you to understand one thing. They have to tell us when they're going to die. Unfortunately, most people can't tell us when that's going to be. So trying to choose a time at which they think it might be gets to be a conversation in itself. Many people will go to their family history. Well, my mom and dad, they lived to such and such age, so maybe that's probably it for me. I can tell you that as a general rule, they say that's maybe 1/3 of the case. You really 2/3 is your own lifestyle. You know, if your parents were smokers or drinkers and you're not, and you play and exercise is a big part of your daily life, then maybe your longevity is going to be a lot more. But knowing when that is a huge, huge deal. So if we have what your income's supposed to be, we know approximately how long you think you might have to live, then we can give you the best strategy. And knowing that's very important. Now, there's some other factors that play a role in this too. You know, am I still working? Okay. Yes, if I wait and take Social Security and I'm not working, you know, how am I going to bridge the gap? Where am I going to take income while I'm waiting to take Social Security? Because you have to understand, if I'm not working, I'm waiting to take Social Security, then where's my income going to come from? It's going to have to come from my savings. And you don't want to dwindle that down to what we would call critical levels. Now, there's a lot of other things that come into play with Social Security. Used to be the ability to file, take half your spouse's benefit while you let your own grow. They called that a file and restrict. That's been limited now depending on what your age is. If anything, folks, know that if it's getting time close for you to take Social Security and you want to understand what the benefit might be best for you to take it at, then give us a call. Again, no cost, no obligation to sit down to run it through these optimization tools we have and see what best fits for you.
Well, Larry, I really appreciate you diving into RMDs, those required minimum distributions. I don't know, guys, for you, but I come across so often where people just say, well, I'm going to get to that. And you may be in that case as well, where you're saying, well, eventually, when I get to 70 and a half, I'll deal with it at that time. But there's so much planning that you can be doing ahead of time, whether that's looking at, okay, how can you start distributing some of that money earlier, or maybe looking at Roth conversions or life insurance planning to ultimately leave a greater legacy to family or charities, whatever your interest is. And so planning comes in very important with RMDs, but also then when it comes to Social Security and setting up a designated income plan.
Right. I mean, I think of both of those topics Larry talked about at the beginning, Social Security and RMDs, are two things folks don't think clearly through in many ways. You know, they're excited to get their Social Security at first retirement in many cases and, you know, get that income stream going. And they think, like you said, RMDs, that's 7.5, that's 10 years from now, or that's for, you know, whatever it is. But yet there's so many things you can be doing now, and if not properly planned out, they really can hurt you in the long run, costing you money or leaving money on the table. You know, and when you have a full income plan or retirement plan, these are things you can maximize and really make to your benefit long term. And even then, like you said, you know, leaving the legacy pieces in both of these situations that can really maximize your family's wealth or legacy, you know, to live beyond you.
Yeah. I mean, honestly, what you guys are talking about is just doing some planning ahead of time. You know, what grieves me is when I see people, you know, they come into the office, they've already starting to take Social Security, and they didn't give us an opportunity to maybe sit down with them before they pulled the trigger to see how that maybe played a part in an income plan. And then I think of a tax plan. You know, what I like to do is we like to take that RMD, right, and see what tax bracket they're going to be in, and maybe there's some planning we can do around that as well. So if that's somebody that, you know, you're not yet taking Social Security, or you want to see what that looks like, maybe an income plan, then I encourage you to give us a call. Now stay tuned, because in the next segment, I'm going to be talking about, and really this is with insurance products, but it's called income riders that are most particularly associated with variable annuities and fixed index annuities. A lot of you have them out there, and a lot of times you don't understand what these riders are, so we're going to talk about it.
Today's retirement challenges can be mastered. Knowledge is power, because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors, specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the Tax Reform Act, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, December 10th at the Evergreen Resort in Cadillac. Wednesday, December 11th at Boone's Long Lake Inn in Traverse City, or Tuesday, December 17th at Big Buck Brewery in Gaylord. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825.
Welcome. Now in this segment, what I want to talk about is what we call income riders. Now folks, these are things associated with insurance products, okay? The two I want to talk about today are what are called variable annuities and fixed index annuities. Now these can be very complicated financial instruments, but I'm just going to try to touch on some basic things that you need to understand when you're looking at these kind of financial instruments. A lot of you have these out there and you don't even know what you have. So let me kind of walk through how to kind of look at these. First of all, you have what's called variable annuities, all right? Now these are, again, insurance products, but they'll typically have two sides to the investment. First of all, they'll have an account value side. Now on the account value side, it's just like any kind of an investment account. There's investments within it, and it can grow if markets are cooperating, or it can go down if not. Now, they look similar to mutual funds, but they call them sub-accounts. And again, you have to understand that the account value can go down if the markets don't cooperate. Now, they have another side to them called a guaranteed withdrawal income benefit. Now, this is where you hear the word guarantee, but you got to be careful, because any kind of a guarantee when it comes or associated with an insurance company is only backed by the full faith credit ability of that insurance company. So you got to be very careful. But what the insurance company is going to give you is some kind of guaranteed growth, or some growth that gets ratcheted up or reset every time the market cooperates and then can't go down. So a lot of people will think, oh, I got something that's guaranteed. That's very true as it relates to the income, okay? Because at some future date, whatever this amount is, you can trigger a lifetime income that's guaranteed, but it doesn't mean that the account value can go down. I see a lot of people that got these variable annuities with the account value down here because it took market risk, this guaranteed income benefit that might be here, but that's the only way they're going to get any benefit is if they trigger it that way. Now you have also what's called fixed index annuities, a little bit different. They also have two sides similar to the variable annuity, but on this side it's an account value usually tied to some kind of an index that can't go down in value but only go up based on how much participation they're going to give you or whether they put a cap on it or not. But it's an instrument that can go up but can't go down. But it also has a guaranteed withdrawal income benefit that can grow guaranteed as it does with a variable annuity. Now they're all different, all right, but you have to understand the differences between these. Now the other thing you have to understand is that to have this guaranteed withdrawal income benefit, many of them are going to charge a fee to this side. And knowing what those fees are is very, very important. The other negative with these kind of financial instruments is the insurance company is going to require you to be connected or obligated to it for some period of time. Very similar to like a long-term CD or such. Otherwise, there's some penalties associated with it. So hopefully this gives you just a little basic understanding of them. If you have one of these financial instruments and you really want to know what you have, then give us a call. Hi, welcome back. Now listen, in this segment I want to talk about tax planning. All right, now there's a big difference between a tax planner and a tax preparer. The best way for me to illustrate this is think about tax season. When do you have most of your income tax documents? Wouldn't you agree that whether you open up the mail that says important tax information or not, that mostly everybody's got that by at least the middle of February, right? And then I can tell you that most people like to have their taxes done by April 15th. So if they're getting most of their documents by middle of February and they want it done by April 15th, how much time is that for most preparers to get all the tax returns done? Literally only 2 months. Now think about that. How much tax planning do you think they're doing in that 2-month period? Now, I had my own tax and accounting practice for over 25 years, and I can tell you during that 2-month period, I was just trying to get taxes out the door. I used to pride myself on giving people, advice, maybe looking at some observations, maybe showing some things they could do to save money. But the kind of tax planning I'm talking about, running mock returns and strategizing and that kind of thing, wasn't happening in that period. So a lot of people think they've got a tax planner, but really all they got is a tax preparer. Now, what's involved in income tax planning? Now, for most people that we work with, soon to be retired folks, the kind of tax planning we're talking about is really tax bracket optimization. If somebody's got Social Security income, maybe they got pension income, maybe they got part-time employment, maybe they still got wages, and now they have to take money out of the IRA, that's right on top of all that other income. What bracket do they find themselves in? And if there's any room in that bracket, that is a great opportunity to do what's called Roth conversions. You know, that the idea that we're going to pay the tax on the IRA and convert it over to a Roth IRA. Now, let's say I'm in that, let's say 22% tax bracket. I'm always going to be there based on all my other income. And I know when I take money out of my IRA, it's going to fall in that bracket. What I'm conceding is that Uncle Sam now has got a 22% interest in my IRA. I have a partner in that account. So knowing that if I've got any room in that bracket, why would I not go ahead and accelerate money out of the IRAs, convert it into a Roth, pay the tax on it at the 22% rate, and convert it, because I'm basically going to pay that no matter what. If tax rates ever go up in the future, well, guess what? I've saved, I've got it out of there early, growing in a Roth, tax deferred. Now, IRA exit strategies is another thing. How do I get that partner out? Well, Roth conversion is one way. How about life insurance? If I know Uncle Sam's going to get 22 cents on the dollar, what if I had a life insurance policy there to pay it off Uncle Sam, maybe when the first spouse died? So tax planning, there's a lot involved in it. Encourage you, if you're somebody that does not have a tax plan and you want one, then give us a call. We'd be glad to sit down and see if you're not a Roth conversion candidate.
Great information, Larry. You know, those are two topics that are, you know, we don't hear a lot about, and sometimes taxes, you know, one topic no one really wants to talk about in some cases when they should. But the first one there, that income from those annuities and the income riders there, you know, those are different things, different ways to take income. Lots of different ways that your retirement investments can produce income out there. But this is one of the options. Now, obviously, owned by an insurance company, so has that benefit to it as well as a difference to it from some investments. But you know, it's almost like taking a little bit of your income and buying income, if you will, at that. Some folks really like it, other folks don't. But it's an interesting way to take a look at it, because what if you could just carve off some of your income or some of your savings from your retirement savings and designate that to produce your income over your retirement? You know, then you have this other piece of money out there that maybe you don't have to worry so much about, or you don't have to rely on it for the majority of your income, that you could invest. So different ways to look at it. You know, it's not for everybody, but maybe it's for you, at least worth considering if you haven't taken a look at them. And they change all the time. The way that insurance companies calculate the payouts and stuff is always fluctuating some. So maybe it's advantageous for you at this point in your life.
Yeah, and I think of with those, again, it comes back to planning. And ultimately, when you're trying to structure an income plan, you also need to be factoring in the tax planning aspect of this. And earlier in the show, we were talking about your required minimum distributions and Social Security, and there's so many different other areas that you're looking at when it comes to setting up a long-term income plan, and taxes play a vital role in that. And so you want to be ultimately considering where your tax brackets are, not just today, but where they might be later on in life, and you can try and project what taxes might be down the road. Nobody knows for sure, but it's one that you have to be super careful with that and make sure that it's a big piece of your overall retirement plan.
Yeah, again, like we always talk about, plan, right? And there's so many aspects that you have to, you know, piece together for somebody when they're looking at their income plan, estate plan, tax plan. So, but Art, I just want to say, you know, when you're talking about the annuities, the reason I wanted to, you know, have that segment and talk about it is so many people have these financial instruments and they have no idea what they got. They'll remember words like guarantee and they think the whole thing is guaranteed, where certain parts of that may not be. So I hope you got great value out of that, learning more about those. If you're somebody that has an instrument like that and you want some analysis done on it to see what you have, then by all means give us a call. Now stay tuned, because in the next segment I'm going to be talking about risk and how you can find out how much risk you're taking in your portfolio. So stay tuned. If you're retired or approaching retirement in the next 5 to 10 years, join us for an informative live event. This event is all about you, the challenges you face, and the information you need to help you build the future that you want. There's no pressure to become a client. Our goal is simply to give you valuable information that you can use to make smarter financial decisions. We hope that by the time you leave this event, you'll be one step closer to your retirement goals. Hi, welcome back. Listen, in this segment, I want to talk about risk. How much risk are you taking on? A lot of people have their portfolio, they might have their mutual funds, but behind those mutual funds are a lot of securities. And a lot of folks want to know, Larry, as I'm positioned today, how did this portfolio do in 2008 when the market dropped a full 57%? How did this portfolio do? How did it do back in 2000 through 2002 when we went through that tech bubble and we went through that bear market? Knowing the answer to that question is very, very important. We actually have the tools to be able to show people what that is. We can take your existing portfolio as it is today, run it through an analysis and show you exactly how it did in 2008, how it did in 2000 through 2002, so you know how much actual risk you're taking. What was that drawdown? If I'm somebody that only wants to take 5-10% risk, I don't want to see it lose anything more than that, and the way I'm positioned today shows that I could lose 50%, is that a concern to me? It might very well be. And so we actually have the tools to be able to show you that. We can look at the bonds you're holding. Maybe you're just in fixed income and you have bonds and you want to know what's the credit qualityness of those bonds. One of the biggest concerns we have today is there's been a lot of corporate debt. And you're taking on a lot more risk if you're in what they call that high yield bond area. Well, how much of your portfolio is made up of that? Would that be a question you'd want to have answered? What about the yield of a portfolio? Now, the yield of a portfolio is actual interest and dividends being earned from the underlying securities. Usually, typically, the greater the yield, the lesser volatility you're going to have. So, knowing what that is very important. If it's only got 1% yield, meaning that's all it's getting in income, where's the other growth going to have to happen? It's going to have to come from the speculative piece. So, getting a risk analysis done, and we can do that for you, give us a call, is very important.
Again, Larry, good information there when talking about risk. And if you haven't sort of grabbed it so far, a key thing that we're talking about on today's show is planning. Our goal is to help you plan to retire well. And so often people are maybe missing out on some of those options, such as the income planning, investment planning, tax planning, estate planning, insurance planning, and all those different areas that come together to help you build a successful retirement plan. One of those areas that I think is overlooked a lot, guys, is from the risk perspective. And so often people are maybe looking at it saying, well, why don't I just maybe buy a bunch of different stocks that are paying good dividends? That way I can count on that income and that'll be there for forevermore. And the big concern there, again, comes back to risk and what those stocks might do in the market, especially in a time like we're seeing right now where everyone's sort of a bit unsure of what's going to happen going forward.
Yeah, absolutely. It concerns me when folks come in and they've worked 20, 30, 40 years or more, leading up to this retirement day, but they don't put the same effort in preparing for that financially. They may have done well saving and they may have a nice amount accumulated, but there's not the connection to what they have. They don't know the risk they're taking. They don't know what the yield, the income coming out of that portfolio is going to be. They just know there's a certain dollar amount there. And it concerns me because, what if something happened? What if the market was to drop? What if the income wasn't there? Are you wanting to change your retirement lifestyle for that, or is that something that can be monitored? So all the more reasons that, like John said, we want to help you plan to retire well. Come in for that second opinion, and we'll help you analyze your portfolio and make sure you're on the right path to retirement. Thank you for watching this week of Retiring Well, and we hope to catch you back here to watch us again.